Hello, everyone, and welcome to the second quarter quarterly market perspectives. My name is Broderick Mullins, and I am the portfolio manager at Covenant Wealth Advisors. I will be your host for this presentation. This quarter's presentation is designed to provide a discussion around quarterly equity and fixed income performance along the framework of absolute returns, relative returns, and future expectations for market performance. We begin our discussion with a high-level look at a collection of major asset classes. We can see from the illustration, U.S., international, and emerging markets stocks were all higher during the second quarter, with U.S. stocks leading the charge, returning 8.2%. Returns for U.S. and global bonds were also positive. Next, I'll draw your attention to the upper right-hand portion of the graphic. U.S. dollar was up 2.8% for the quarter, but still down 5.1% over the last 12 months. Now let's look a little deeper at what was driving the returns of stocks and bonds. We'll start by taking a look at how global equities performed for the quarter, and we'll isolate the performance between U.S. and developed international stocks. The two charts here show the performance of different investment styles between U.S. and international stocks. The bright blue bars represent the performance of different investment styles, and the dark blue bars represent the total market performance for the region. U.S. returns are measured with the Russell indexes, and international market returns are measured with the MSCI World ex-US Index Series, which represents global developed market performance, excluding the U.S. As we can see from the dark blue line on the chart on the left, the U.S. market returned 8.2% in the quarter, compared to 5.5% for developed international markets in the chart on the right. Reversing the trend from the first quarter, large growth was the dominant style in both the U.S. and internationally. With the resurgence of large stocks and large growth in particular, we saw small and value stocks underperform the general market. In fact, June 2021 was the most that large growth companies have outperformed large value companies in the US since April 2001. That's not a surprise considering how well small and value companies have performed for the prior year. Now we take a longer view to see how different investment styles have performed for standard periods ending June 30, 2021. Looking at annualized returns in the US, we can see extraordinary returns for the 1 year, as the recent performance still shows the effects from coming out of the COVID market downturn. Small value performance far exceeded the general market over the last year, returning over 73% compared to 44% in the US. However, we see that small value has underperformed most other styles at the 3, 5, and 10-year investment horizons. Consequently, we expect that portfolios that have a small value tilt, such as those that we typically design for clients, will have underperformed portfolios that are market cap weighted or tilted to large growth stocks at these longer investment horizons. It is important to recognize, however, that despite the underperformance, small value has still returned a formidable 10.8% per year in the US for the last 10 years. Turning to international markets, we see small value has led the pack over the 1 year period, albeit at a slightly lower total return compared to the US. At the longer time horizons, we see small caps, particularly neutral and growth stocks, offering the highest returns over the 10-year period at 7.7% and 8.8% respectively. Relating the prior slides, we see that international markets have underperformed the US market at every horizon, with the 3-year performance trailing by nearly 10% per year, and the 5 and 10-year performance trailing by 7 and 9% per year, respectively. Given the higher US return, we expect portfolios concentrated in US stocks to outperform a globally diversified portfolio. However, as we'll see in the next slide, these relative performance numbers are not reason enough to abandon international stocks. Thus far, we've discussed quarterly performance on a relative and absolute basis. Now, let's take a look at current stock market valuations and how they relate to future expectations of market performance. The charts on this slide show how expensive stocks are by measure of the price to earnings ratio, or PE ratio, which is a very common metric used to value equities. The higher the ratio is, the more expensive the asset class is overall. Thought of another way, these values depict how expensive $1 of earnings is. For example, as we can see in the chart on the top left, the average dollar of earnings for the total US stock market costs roughly $25. Internationally, as we can see in the chart on the top right, earnings are cheaper at roughly $20 per dollar of earnings on average. The values represented here used historical funds and ETFs to establish the price ratios. And the average PE is reflected by the dotted line on the chart. These averages start in the first quarter of 2004 for US measures and in the fourth quarter of 2006 for international stocks. So the average is roughly 18 years in the US and 15 years internationally. In addition to identifying relatively cheap segments of equity markets, these ratios also help set the table of forming expectations about the future. Although we like to say our crystal ball is always cloudy, there tends to be an inverse relationship between current equity valuations and future performance. Generally, investors will bid up the price of certain stocks in expectation of higher future earnings. Therefore, as a particular group of stocks becomes more expensive, their expectations for future earnings growth are lessened because investors are less willing to pay an ever-growing premium for those expected earnings, especially when earnings can be bought elsewhere for less. I'll emphasize that this is a long-term relationship. And as we've already seen on previous slides, there is a wide range of possible short-term outcomes. Here we have the same analysis, but isolating US equities, so we can see how valuations compare across different styles. Recalling the annualized performance slides, we know that large growth has had an exceptional 10-year period. We can see that the growth in prices has exceeded the growth in earnings, as the PE ratio has climbed to 36.4 to close the quarter. Small value, on the other hand, even with the rebound in the last 9 months, still has a PE ratio under 14 and under the average of the last 18 years. Although many investors may be interested in chasing the returns of large growth companies, we would point to these valuation charts as one reason to stay the course in a diversified portfolio tilted to small, distressed companies. Next, we'll take a look at fixed income performance, the shape of the current yield curve, and how the market is currently pricing inflation. The charts on the screen here show the average performance of different bond maturities and the segments of the fixed income market that we commonly track. We typically prefer investing in bonds that are shorter maturity and higher quality compared to the broader market. In the chart on the left side, we see short to intermediate term bonds posted moderate performance, with the 3 to 7 year maturities returning 0.7% for the quarter, but were outperformed by longer dated bonds as the longer end of the yield curve fell. It's worth noting that the extreme price fluctuations that we see in the 10 to 20-year bonds are why we like to keep maturities short to intermediate. Although it was a tailwind this quarter, we've seen plenty of quarters historically where the yield curve has moved against us. The chart on the right shows the performance of different intermediate maturity credit quality bonds. We see that inflation-protected bonds have continued to be bid up as more investors seek to hedge their exposure to inflation. Treasuries returned a modest 0.6%, while corporate and municipal bonds returned 1.7 and 1.1% respectively, indicating tightening credit spreads and investors becoming more comfortable with the debt of corporations and municipalities compared to the end of the first quarter. Next, we'll look at the Treasury yield curve and what it means for returns going forward. Here we plot the yield curve to show the current yields for Treasury bond investments at different maturities. The bright blue line represents current rates, the dark blue line represents interest rates at the end of 2020, and the gold line represents rates 1 year ago. In short, the early part of the curve is steeper and is elevated overall compared to the end of 2020 and 1 year ago. Practically, this means that expected returns on fixed income are higher, but that Treasury returns would have been negative year to date and over the 1 year period. It's worth noting that most of the yield curve changes year to date happened in the first quarter, and that rates fell between the end of the first quarter and the end of the second quarter, which is why we saw positive performance from bonds in the second quarter, despite seeing higher yields compared to the first part of the year. Now we plot the market's forecast of inflation by taking the difference in yields between US Treasury bonds and TIPS at different maturity levels. Like the last chart, the bright blue line represents current inflation expectations, the dark blue line represents inflation expectations at the end of last year, and the gold line at the end of the second quarter last year. Consistent with what many are expecting and what we're hearing in the media, inflation expectations are higher compared to this time last year, or even compared to the end of 2020. It is important to remember that these levels of inflation are baked into prices today. The markets are pricing an average inflation rate of 2.5% per year for the next 5 years, and the market collectively expects inflation to exceed the Fed's 2% target over the next 30 years. Not only are these expectations baked into bond prices, but they are also baked into stock prices. Making a bet on higher inflation would mean that we expect inflation to exceed the current forecast. The market already expects inflation to be higher than what was previously expected over the last year. Finally, what does all of this mean as it relates to a diversified portfolio? The chart in front of you should be familiar. We call this the Skittles chart at Covenant Wealth Advisors because it resembles a handful of Skittles candies thrown on the table. Each column represents a calendar year, and each color rectangle represents the return for the segment of the stock or bond market, what we call an asset class for that particular year. In this hypothetical example, the white box represents a diversified portfolio of indexes without fees. As you will notice, the returns are quite random from year to year, making it nearly impossible to predict which part of the market to invest in from 1 year to the next. The one constant is the white box, which represents a hypothetical diversified portfolio of indexes containing 65% stocks and 35% bonds. Notice that the white box is always somewhere in the middle of the return year by year. It is never the worst performer, and it is never the best performer. This is by design. However, you'll also notice that the 15-year annualized return for the diversified portfolio, again, the white box, is 6.6%, the fourth best performing of the 11 asset classes. While this is no predictor of the future, What this does illustrate is that staying the course through good years and bad may be the best approach. That is, of course, our mantra here at Covenant Wealth Advisors. And with that, we've reached the conclusion of the presentation. As always, we hope you learned something new, and if you are an existing client, thank you for your trust and confidence.